Debunking the hype. Are Bitcoin leveraged ETFs right for you? Hey chat, ETF fam. Ever heard of Bitcoin leveraged ETFs? They're like Bitcoin on steroids, promising amplified gains, but also amplified risks. Are they the get-rich-quick scheme you've been dreaming of, or a financial nightmare waiting to happen? Buckle up, because in today's video, we're breaking down everything you need to know about these controversial investments. We'll unveil the truth behind their promises, explore the hidden dangers, and even offer some safer alternatives for your crypto journey. So, hit that like button, smash that notification bell, and let's dive into the world of Bitcoin leveraged ETFs. Question 1. What is a BTC leveraged ETF? A BTC leveraged ETF, exchange-traded fund, is an investment vehicle designed to amplify the daily returns, both positive and negative, of the Bitcoin price. Unlike regular Bitcoin ETFs, which simply track the price of Bitcoin, leveraged ETFs use financial instruments like futures contracts to magnify the daily movements by a certain factor, like 2x or 3x. Here's a breakdown. Amplifies returns, aims to deliver returns that are a multiple of the daily percentage change in the price of Bitcoin. Double-edged sword. While offering the potential for greater gains, it also comes with the risk of amplified losses. If the price of Bitcoin goes down, the losses are also magnified by the leverage factor. Not yet available in the US. As of March 3, 2024, there are no approved BTC leveraged ETFs in the United States. However, there are similar products like inverse Bitcoin ETFs that aim to deliver the opposite of Bitcoin's daily performance. It's crucial to remember that leveraged ETFs are complex financial instruments and carry significant risks. They are generally not suitable for all investors, especially those with a low risk tolerance. Here are some additional points to consider. Volatility. Leveraged ETFs tend to be more volatile than regular Bitcoin ETFs, meaning their prices can fluctuate more significantly throughout the day. Fees. These ETFs typically come with higher expense ratios compared to regular Bitcoin ETFs, due to the additional costs associated with managing the leverage. Regulations. The regulatory landscape surrounding leveraged ETFs, especially for cryptocurrencies, is still evolving. Question 2. How do BTC leveraged ETFs work? While BTC leveraged ETFs are not currently available in the US, understanding their mechanism can be helpful for future reference, or when considering similar investment products. Here's how they work. 1. Underlying mechanism. Unlike regular Bitcoin ETFs that hold actual Bitcoin, leveraged ETFs use financial instruments like futures contracts. Futures contracts are agreements to buy or sell Bitcoin at a predetermined price on a specific date in the future. 2. Leverage amplification. Leveraged ETFs aim to achieve amplified returns by using leverage, which is essentially borrowed money. The ETF uses this borrowed money to enter into multiple futures contracts corresponding to the desired leverage factor, e.g., 2x or 3x. 3. Daily rebalancing. To maintain the desired leverage throughout the day, the ETF needs to rebalance its holdings based on daily price movements of Bitcoin. This involves adjusting the number of futures contracts held by the ETF. Example, hypothetical. Imagine a 2x leveraged BTC ETF with a net asset value, NAV, of $10 million. If the price of Bitcoin increases by 1%, the NAV of the ETF should ideally increase by 2%. To achieve this, the ETF manager might use the $10 million to enter into futures contracts that are equivalent to owning $20 million worth of Bitcoin. Important points here. Complexity. Managing leverage and daily rebalancing requires complex strategies and exposes the ETF to additional risks. Compounding effect. The impact of daily rebalancing can be compounded over time, leading to significant deviations from the targeted leverage ratio, especially during periods of high volatility. Decay of leverage. In downward trending markets, the rebalancing process can lead to a gradual erosion of the targeted leverage, resulting in lower than expected returns. Question 3. How do BTC leveraged ETFs manage leverage? As mentioned previously, BTC leveraged ETFs utilize futures contracts to achieve their targeted leverage. Here's a deeper dive into how they manage this leverage. 1. Entering and exiting futures positions. Initial leverage. The ETF manager uses a portion of the fund's assets to enter into futures contracts. The notional value of these contracts is a multiple of the fund's net asset value, NAV, corresponding to the desired leverage ratio, e.g., 2x or 3x. Daily rebalancing. Throughout the day, the ETF constantly monitors the price of Bitcoin and adjusts its futures positions to maintain the targeted leverage ratio. Price increase. If the price of Bitcoin increases, the value of the fund's existing futures contracts will also increase. The ETF manager might then sell some of these contracts to realize profits and use the proceeds to purchase additional assets, like additional futures contracts or other instruments, to maintain the desired leverage. Price decrease. Conversely, if the price of Bitcoin decreases, the value of the futures contracts will also decrease. The ETF manager might need to purchase additional contracts or use other strategies, like using swaps or options, to counteract the losses and maintain the target leverage. 2. Techniques for managing leverage. Cash allocation. The ETF might hold a portion of its assets in cash. This cash can be used to enter into additional futures contracts when needed or to meet redemptions from investors. Swaps and options. In some cases, the ETF manager might utilize swaps or options contracts to manage exposure and hedge against potential risks. However, these instruments add complexity and can introduce additional costs. 3. Impact of rebalancing. Compounding effect. The daily rebalancing process can have a compounding effect over time, especially in volatile markets. Even with perfect execution, the actual return of the ETF might deviate from the targeted leverage ratio due to the impact of rebalancing costs and the nonlinear nature of futures contracts. Decay of leverage. In downward trending markets, the rebalancing process can lead to a gradual erosion of the targeted leverage. As the value of the ETF's holdings decreases, the manager might need to sell some assets to meet margin requirements, resulting in a lower effective leverage compared to the initial target. Question 4. What are the different types of Bitcoin leveraged ETFs? As of March 3, 2024, there are no approved BTC leveraged ETFs in the United States, or any other major market for that matter. Regulatory bodies are still cautious about the potential risks associated with these products. However, there are other types of Bitcoin ETFs available, such as Bitcoin futures ETFs. These ETFs invest in Bitcoin futures contracts, instead of holding the actual cryptocurrency. This allows investors to gain exposure to Bitcoin without the need to store it themselves, but they still track the price of Bitcoin indirectly. Inverse Bitcoin ETFs. These ETFs aim to deliver the opposite of Bitcoin's daily performance. They achieve this by using various financial instruments, like swaps and options, to profit from a decline in the price of Bitcoin. Question 5. What are the benefits of investing in BTC leveraged ETFs? It's important to understand that BTC leveraged ETFs are not currently available and carry significant risks, making them unsuitable for most investors. However, for the sake of comprehensive information, here are some potential benefits that theoretically come with investing in them, were they to be available here. Amplified gains. The primary allure of leveraged ETFs is the potential to magnify your returns if the price of Bitcoin goes up. If the price increases by 1% and the ETF has a 2x leverage, you could potentially see a 2% return on your investment. However, this benefit is also a major risk here. Amplified losses. Conversely, if the price of Bitcoin goes down, your losses are also amplified by the leverage factor. A 1% decrease in price could result in a 2% loss for you. This can lead to significant financial losses and even complete erosion of your investment. Here are some additional potential benefits. Potential for short-term gains. Leveraged ETFs can be used for short-term speculation on the price of Bitcoin, aiming to capitalize on brief upward movements. However, this strategy is highly risky and requires close monitoring of the market. Hedge against a short position. In theory, leveraged ETFs could be used to hedge a short position in Bitcoin. However, this strategy is complex and carries its own set of risks. It's crucial to remember that these potential benefits are outweighed by the significant risks associated with BTC leveraged ETFs. They are generally considered unsuitable for most investors due to high volatility. Leveraged ETFs tend to be more volatile than regular Bitcoin ETFs, meaning their prices can fluctuate significantly throughout the day, amplifying both potential gains and losses. Complexity. These ETFs involve complex financial instruments and strategies, making them difficult to understand and manage for the average investor. Tracking error. Due to the compounding effect of daily rebalancing and other factors, the actual return of the ETF might deviate significantly from the targeted leverage ratio. Decay of leverage. In downward trending markets, the rebalancing process can lead to a gradual erosion of the targeted leverage, resulting in lower than expected returns. Regulatory uncertainty. The regulatory landscape surrounding leveraged ETFs, especially for cryptocurrencies, is still evolving. Question 6. What are the risks associated with BTC leveraged ETFs? Here's a detailed breakdown of the major risks associated with these products. 1. Amplified losses. The most prominent risk is amplified losses. While they offer the potential for magnified gains, any downward movement in the price of Bitcoin is also amplified by the leverage factor, leading to potentially significant financial losses that could even wipe out your entire investment. 2. Volatility. Leveraged ETFs are inherently more volatile than regular Bitcoin ETFs due to the use of leverage. This means their prices can fluctuate significantly throughout the day, making them unpredictable and risky for most investors. 3. Tracking error. Due to the compounding effect of daily rebalancing and other factors, the actual return of the ETF might deviate significantly from the targeted leverage ratio. This means you might not achieve the returns you were expecting, even if the underlying asset price moves in the predicted direction. 4. Decay of leverage. In downward trending markets, the rebalancing process can lead to a gradual erosion of the targeted leverage. As the value of the ETF's holdings decreases, the manager might need to sell assets to meet margin requirements, resulting in a lower effective leverage compared to the initial target. This can further amplify losses and significantly impact your returns. 5. Complexity. These ETFs involve complex financial instruments and strategies like futures contracts, making them difficult to understand and manage for the average investor. This complexity can lead to poor investment decisions and increased risk of losses. 6. Fees. Leveraged ETFs typically come with higher expense ratios compared to regular Bitcoin ETFs due to the additional costs associated with managing the leverage and the use of complex financial instruments. These fees can further eat into your potential returns. 7. Regulatory uncertainty. The regulatory landscape surrounding leveraged ETFs, especially for cryptocurrencies, is still evolving. This uncertainty can pose additional risks, as regulations might change in the future, potentially impacting the way these products operate, or even leading to their ban. 8. Margin calls. If the value of the ETF's holdings falls below a certain level, known as the maintenance margin, the investor might receive a margin call. This requires them to deposit additional funds to maintain the required leverage, which can be difficult or impossible in volatile market conditions, potentially leading to forced selling of assets at a loss.